Last board meeting of the year. Let me call the meeting to order. This is the Federated City Employees Retirement System and Healthcare Trust meeting for December 2023. We will do a roll call to see who is here. Vice Chair Jennings.
Here.
Trustee Abbott.
Here.
Trustee Avasti.
Here.
Welcome back. Trustee Chandra, I understand, is absent. Trustee Faulkner.
Here.
Great. And Trustee Linder. Here. I believe we have quorum.
So if I may qualify Trustee Jennings and Trustee Faulkner, please. So Trustee Jennings, I'll start with you. Can you please provide the address from where you are teleconferencing from?
855 East Hilton Drive, Boulder Creek, California.
And is the location from where you're teleconferencing ADA accessible and open to the public?
Yes.
Can a member of the public be heard by us from your location?
Yes.
And have you posted the agenda from the location you're teleconferencing from?
Yes.
Trustee Jennings has been qualified under the traditional Brown Act rules for teleconferencing. Trustee Faulkner, are you teleconferencing from the address of 420 Star Hill Drive, Cape Carteret, North Carolina?
That is correct.
And is the location from where you're teleconferencing from ADA accessible and open to the public?
Yes, it is.
And can a member of the public be heard by us at your location?
Yes.
And have you posted the agenda at the location where it can be publicly seen?
Yes.
Trustee Faulkner has been qualified under the traditional teleconferencing rules for the Brown Act.
Very good, thank you, Council Chin. Just cause AB 244, I believe that's what we've just done. A few ground rules, all votes, as this is a hybrid meeting, will be roll call votes. There are some changes in the orders of the day. Under Section 6, new business, item 6G will be heard first before items 6E and 6F. Audit Committee, item 7.2B will be heard after item 6G. And just pointing out that the Joint Personnel Committee meeting is scheduled for tomorrow at 9 a.m. Do we need December 22nd. Do we have a motion to approve the orders of the day?
So moved, Mr. Chair.
Thank you. That's Trustee Linder. Is there a second?
I'll second.
We have a second from Trustee Abbott. Any discussion, any public comment? Hearing none, we will vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
Okay, it passes. We will move forward to waiving sunshine. There were some attachments that were posted late. One is the new business item 6G, discussion and action to approve Macias, Ginny, and O'Connell agreed-upon procedures report. And secondly, the Audit Committee, item 7.2B, discussion and action for approval of the Federated City Employees Retirement System annual comprehensive financial reports. Do we have a motion to waive sunshine?
So moved.
We have a motion from Trustee Linder. Do we have a second?
I'll second.
Second from Trustee Abbott. Any discussion, any public comment? Hearing none. Vice Chair Jennings, how do you vote?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And I vote aye as well. That is approved. At this time, members of the public may comment on items not included on the agenda, provided that the matter is within the subject matter jurisdiction of this board. Members of the public who wish to provide comment at this time may do so by raising their hand on the Zoom app, or if joining by telephone, by pressing *9 on their telephone, or if they're here present. Speakers will be limited to 3 minutes. In addition, public comment on items listed on the agenda will be taken at the time the item is addressed at this meeting. Is there anyone waiting online for public comment? I'm seeing no, and there is no one here, and so we will move forward to the consent calendar. Is there any item that anyone, board or staff member, would like to pull from the consent calendar? Seeing none. So we also need a motion to approve the consent calendar. Do we have such a motion?
Mr. Chair, I will move to approve the consent calendar.
Okay, thank you, Trustee Linder. I believe that's the hat trick, 3 for 3. Do we have a second?
Second.
And we have a second, the hat trick for Trustee Abbott. Any public comment? Any objection? We will vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And I vote aye, it passes. So we will now proceed with the agenda. And it appears the first item on the agenda is closed session. So we will reconvene to the closed session room.
Mr. Chair, do you approve the disability applications? You usually do it after you come back from closed session, or?
I believe is that either a part of the consent
Well,
calendar?
that's what I thought, but then here I realized the consent calendar starts on number 2, so we have to make sure that they start, consent calendar
I see.
start with 1, so
Well, right, we've taken it out of order, so, but I guess the question here is for the two applicants, do we have them present? Are they gonna be presenting or
No,
not?
they usually are on consent, this
Oh,
matter,
those two.
and they're told that if there are any questions, we'll have to bring the item back for discussion, and that they were invited to attend the
Okay,
meeting if they
that's-
wanted to, but they didn't have to.
I see.
Well, we can approve those applications for change now before we go to closed session.
Please, thank you.
Do we have such a motion?
We're talking about,
This is item 1 now, application for change in status for service-connected disability, and there are two sub-items, A and B, two different people.
and the
With
recommendations
recommended,
are
we have the recommendations from the Disability Committee. So do we have a motion then to approve those denials?
I think,
Trustee
Chair,
Jennings.
Yeah.
I'm
Had-
sorry?
Trustee Jenny makes the
Okay, sorry, I didn't hear you. Vice Chair Jennings is a motion. Do we have a second?
Second.
And it's second from Trustee Faulkner. Is there any public discussion and any comment from trustees?
just to know, Mr. Chair, that the Disability Committee did discuss this, worked with the staff on this, worked with anybody who was present,
Mhm.
and we are recommending denial on both of these.
Okay, thank you for your work on that. So then, hearing no further comment, we will vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And I vote aye as well, so those applications are denied. So now, we will move to item II, which is closed session for new business deferred continuing items. So let us retreat to our closed session room.
And Mr. Chair, are you gonna take the two closed session items in the order they appear?
Is there any reason not to?
I'm not sure if the city information security officer
They
is
will be here
attending
later,
to be,
so yeah,
oh, later,
we should
okay.
So,
that order.
okay, so we'll take them in order, A first, then B?
Okay, I will stay recused for the first item, and then once that item has concluded, if someone can please get me.
We will let you know. Yeah.
Thank you.
Okay.
Thanks.
Closed sessions are getting longer and longer. I believe the next agenda item is number 3, death and...
Recording in progress.
Thank you. Death and survivorship. We'll observe a moment of silence for those who have served the city and who have passed. Okay, thank you.
And Chair Horowitz, before we move on, I just want to note for the record that Reed Smith had recused ourselves from closed item 2A.
That is correct. Thank you. And there's no reportable actions out of either
Correct.
closed session item.
I can't speak for the first one, at least with
Trust me.
respect to closed session 2B, no, there's no reportable action.
Yes. On to item number 4, investments. 4A, an oral update from our CIO, Mr. Plani.
Thank you, Mr. Chairman. Good morning, trustees. On this, the shortest day of the year, we do have a somewhat of a longer investment piece.
We're going to consume much more of daylight hours in
Yes,
this meeting
yes,
than we
yes.
dare.
Adds to my seasonal affective disorder. But, unless you have questions, I'm going to actually invite, I believe we have Casey from Newburger to present 4B. This is the fiscal first quarter performance review, the third quarter of the calendar year. And of course, as you all know, private markets lag by 1 quarter. So in terms of private markets, it'll be as of June 30th, but the overall performance will be as of September 30th.
Did you want to update us on the latest status of the program as of a day or two ago, as you usually?
Oh,
normally do?
yeah. For what it's worth.
Are we making money?
We are making money, thanks to Mr. Powell.
Mhm.
And as of 2 days ago, I believe the plan was up 3.68% fiscal year to date. And the healthcare trust, I believe, was up 3.24%. Again, these are not exact numbers, but directionally, the market's up. And so this is good. We are
Great.
inching closer to our discount rate.
Absolutely.
But there's just a lot of time left
Okay,
between now and June 30th.
keep pedaling.
Yes, we will keep praying to Saint Powell. With that, sir,
Mhm.
I'm going to invite Casey Boyer.
Thank you. It's nice to be here. Always appreciate the opportunity to give you an update. I am going to share my screen. Let me make it a little bit bigger so everyone can see. Great. As he mentioned, we are going to be discussing and going through today Q2 information for the private equity strategic partnership that we have. And I'll start a little bit more broadly and try to be pretty effective and efficient with your time. Q2, the last couple times I've come on here, I've said a similar message, which is everything is pretty much the same. So the difference between Q1 and Q2 was very minimal. If you look at the net multiple and return, it went from 1.82 in Q1 to 1.84 in Q2. So not a lot of movement across the board. Private equity held very steady and performance valuations were around par for Q2. This year, 2023 in general, has been similar to that message. What has slowed down are distributions and realizations across the board, and slightly within your portfolio, although I would say in certain instances, we have seen positive realizations and we have been able to distribute some capital. So you'll see for Q2, you have distributions of 45.1. Post Q2, we made 2 separate distributions, one in October and one in December, which accounted for a little over 7 million. So you are starting to see some capital back, and hopefully that will continue into 2024. As a market, we are expecting distributions, realizations within private equity overall to be more than they were in 2023, which would be nice because in 2023 they were very low to historical numbers. In terms of performance expectations for Q3, as I mentioned, I think it will be quite similar. Valuations will probably be more of the same, and hopefully we'll see some of those additional distributions. I'm going to go to the performance analysis page here in the back and just go a little bit more into detail on the performance, both at a gross basis, which is the performance of the actual investments, and then at a net basis. So we like to look at the performance by each investment type, primaries, secondaries, and co-investments. again, a lot of these numbers did not change a lot from Q1, but it is nice to see how each one of them is contributing to the portfolio. Primaries will still very much develop over time. We're still consistently committing capital within the program. And so those primary funds will continue to invest over time and have different time horizons. So you'll continue to see this, this number build over time. Secondaries have done well. Secondaries are meant to produce early distributions, which you can tell from the gross TPI they have done. They've returned 1.25 times back already to the program. And then co-investments are really a shotgun approach to gaining exposures to companies with high expectations. So the TVPI and return generation within co-investments is something we want to see higher than the rest of the portfolio, which again is happening. When we look at the bottom, net performance benchmarking, this is comparing your private equity program with Neuberger to peers. You can see we're showing the Q2 numbers, as I mentioned, and then the Q1 numbers, which are very much similar from quarter to quarter, not a lot of change. And then how your portfolio is benchmarking against peers with a first quartile benchmark on IRR and a second quartile benchmark on TVPI. Again, those could always change over time, but happy with where the performance is to date. Hoping to see more distributions and valuation uplift in 2024. And that the realizations really is the expectation that we should be receiving more distributions, although very unclear how much uplift that will be. So I will pause there and open it up to any questions.
I have a quick question. On the benchmark first quartile, 22.87%, is that the average for the quartile or the threshold above which one is in the quartile?
That's the threshold. So if you're there or above, you are first quartile.
Okay, so we're slightly above the threshold.
We just barely made it.
Okay. Any questions from other trustees?
I do have a question. In terms of the 0.29 DPI for primaries, is that about what you expected? Because you said that that'll be going up in the future. Or is that, it seems low compared to the other ones, and I know that that's because it's a relatively young investment, but I'm just curious about that.
Yeah, exactly. If you think about it, primaries take longer to deploy capital. Those primary investments and those fund investments that we're making, they're investing into companies over 2, 3, 4 years. So if they're making an investment in year 4, we very well may not get capital back from them until year 8, 9, or 10. Also on top of that is in our program, we are also making new primary commitments to primary funds. And so we're always going to have a level of capital that still hasn't even been invested, and therefore distributions won't have happened. So that number is to be expected when it's in a portfolio like this that's continuing to commit over time.
Any other questions from trustees? By the way, just checking, our 2 trustees who are joining us remotely, are they online with us? Okay,
Yes.
great. Okay, let's move forward with the presentation.
All right, thank you, Casey. With that, Mr. Chairman, we move to 4C, and I'd like to invite Laura Weiring.
Thank you. Good morning. I wanted to commend this board for continuing your dedication to the participants. I noticed when I was looking up the agenda yesterday that all other city meetings for today were canceled, likely with the holiday coming up. So
Yep.
I think the participants are lucky to have you all looking out for them a few days before the holidays.
There's no rest for the wicked.
So, and now I see that my Zoom has already kicked me off. Are you guys able to share the presentation, or should I join back on? It was there a minute ago. I can try to log back on as well. I can log back in. All right. Sorry for the delay.
Recording in progress.
Okay, so I will share my screen. Let's go. Coming up here. So first we have the public version of the private markets report. Sorry for the technical difficulties here. The public internet is letting me down. Here we go, finally, sorry about that. Okay, so I will be quick in the interest of time after that delay. If we take a look at page 1, you can see the total on the far right internal rates of return in the second from right column for each of your individual private markets programs relative to a public markets equivalent. There are a lot of different ways to look at your private markets performance relative to benchmarks and peer universes, but a public markets equivalent, I think, is a pretty pure one in terms of taking the same amount of money that each private markets partnership called at the same time that it called and putting it into a public index, and then the amounts that are distributed, taking it out of that public index. So if you take a look at the IRRs of each of your private markets programs on the second from right column, relative to the public markets equivalent, in the right column, you can see that every program that you have is outperforming since inception relative to a public markets equivalent. Then the first program that I'll briefly talk about is the private debt program, which as of the end of June stood at 4.3% of your total plan, which was slightly above the 3% policy target. There was one new commitment during the quarter, Octagon Fund 5, in the amount of $8 million. And we can look at performance by vintage year and strategy. So you can see here that a few of these funds were from 2010. Those are sort of higher weight in the program. But if we look at the recently committed funds under your current investment staff, and we look on the far right at the IRRs relative to the peer IRRs for peer universes, the source being a widely used peer universe benchmark called Burgess, you can see that these funds are generally outperforming.
I have a question on page
Sure.
4.
Yes.
So I'm curious about why the nearer term, the 2020 and 2021, have a lower TVPI than the ones from 2016 to 2019.
Yeah, I think the commitment to Eagle Point that you see on 2020, if you take a look, is at 3.6 relative to 9.5. Yeah. Eagle Point had some fixed rate loan exposure that didn't adjust with rising interest rates. That's one reason that they're lagging. Also, in private markets, this is a relatively recent vintage. looking at 2020 and 2021. So a lot of realization slowed down during the pandemic, and folks held on to things longer. And so
Yeah.
you can, I think, expect that these are still sort of immature private markets partnerships from those
Okay.
years. Sure. I'm sorry.
Contributed dollars are more than the.
Okay, yeah, good, another good question. Some of these, and I would say probably most of private markets partnerships can recycle capital. So it's within their offering documents, that they're allowed to. If they call your capital, they invest it, they make a realization, they give it back to you. There's a certain time period in which they can recall it if they find another good investment, which I think overall, you commit to these, your staff commits to these partnerships because they believe that the managers are going to do what we've asked them to do and stick to their style and only call the capital if they think they're going to make money on it. So generally that ends up being a good thing, but it results in the called amount being higher than the committed amount. Thanks.
In those circumstances, do we have options, or we're committed to recommit the capital? 'Cause I could see where that could be a source of abuse.
Mm-hmm. Yes, every private placements memorandum and legal documentation is going to have different regulations around that, which is something that can be negotiated depending on the fund. And typically there's a time horizon in which they're allowed to do that, and then after a certain number of years, they're not anymore unless they get specific permission from you all. But it really depends on each individual partnership. And there have been cases in the past. There's one manager in the private debt portfolio that the staff decided they were not going to allow continued capital calls, so with some legal options around that.
And what would be, you say there's typically a time horizon and it's negotiable, but what would be typical in the industry?
It depends on the asset class. Usually private debt has a shorter time horizon than private equity or venture capital, for example. So there's usually, a period of 2 or 3 years when they commit the capital, and then maybe another couple of years after that when they can recycle it, but it really depends on the fund.
Okay. Any other questions from trustees? Yep. Go ahead.
Thank you.
Yeah, I had one quick one with really the first page, the internal rates of return of the public market equivalents and the private. Is there a metric that you can speak on that would capture more of a risk-adjusted basis between private markets and the public market equivalent? I know we have a benchmark of like the plus 100 basis points around typical private investments, I think. Is that standard here as well?
Yeah, that's another really good question, and it's tough to measure because private markets are sort of artificially not volatile, just in terms of we only value them however often, and so we do look at standard deviation, but that's not a great measure of risk. When we look over the long term in the general overall pension plan report, you're looking at very long-term returns and long-term standard deviations. One thing we do when we're planning asset allocation is that Makita develops capital market expectations. Every year we do a study where we look at 100 different asset classes. Not that there's really 100 individual asset classes, but we try to look at anything that an institutional fund might want to invest in, and we sort of artificially inflate our expectations for standard deviation for private markets to try to capture the fact that they're just not valued as often. Otherwise, when you do sort of a mean variance optimization, the model might just put a lot more assets into private markets because it looks like it's not as risky. And so that's something that we try to control for during the asset allocation process.
Any other questions from trustees? Okay, proceed.
This is great. I'm getting lots of good questions today. Thank you. So moving on to the real assets program on page 7, you can see that the total program was at 2.4% of the retirement system relative to a 3% target. There was one new commitment during the quarter to Ridgewood Water Fund 2 in the amount of $5 million. And if we take a look at the individual vintage years and strategies here, you can see that the program is less mature than the private debt program, with the first commitment being back in 2016. You can see on the far right, Kimmeridge Energy in particular with really outsized outperformance. Most of these funds are performing quite well, with the exception of one smaller co-investment in 2020. Crestline, you can see, is the most recent commitment in 2021 with a well above peer median return. The next program is real estate. Real estate stood at 4.1% of the overall plan relative to a 3% policy target with no new commitments during the quarter that we're looking at. But you can see really strong performance over 2 pages here for the real estate program. I believe every fund in your program, with the exception of Torchlight Debt, is outperforming its benchmark. There is some underperformance as well from EPISO 4. That is a European fund, and so some currency movements during the time period that you all have been invested have caused them to lag their benchmark slightly. The DRA funds are ones that you all have been investing in back since 2005, and you can see even recent DRA commitments in 2022. You can see that those funds have been really strong performers in the program and something that are a legacy sort of manager that your staff continues to commit to over time. The last program in terms of private markets is the least mature, the venture capital program, which is pretty new. It equates to 0.5% of the overall retirement system versus a long-term target of 4%. There were no new commitments during the quarter that we're looking at here, and you can see that the performance is largely not meaningful given that venture capital is a very long-term asset class and these commitments just started in 2021.
I have a question. So when I'm looking at this, I see that the total value per divided by paid in TVPI is 0.99. So that says that the value is less than what we've paid in.
So you paid in management fees, which are included in this. So far there haven't been realizations, but you have been paying management fees. So that's pretty typical at the beginning of a program.
Yeah, and 2022 it's 0.85. So it's lower. Does that mean the value could come up?
Yes.
Because it's unrealized value plus realized
Exactly.
value,
Yes,
right?
we certainly expect, can't promise anything, but certainly expect these funds. They're very immature for venture capital. Oftentimes you do have many losses and then some very large gains over long periods of time, but this is typical with the J curve of investing in venture capital, where at the beginning you drop below paid in value as you pay fees, and then it comes up over time.
Okay, so this is looking at what they're currently valued at, but you think there's still potential
Definitely.
behind that?
Yep.
Okay,
That's a longer term thing.
yeah.
And the rest of this report has a wide variety of market charts and data on the individual private markets asset classes, but I'll let you peruse those at your leisure if you need some bedtime or airplane reading, but always feel free to ask any questions on those topics.
I do have one more question. On page 47, it talks about the real estate, and it talks about the index, and one's EV, which is equal weight, but the other one was VW, and I didn't know what VW stood for.
Valuation weighted.
Okay, so
Yeah.
that's the standard kind of index where it's equity, the capitalization weighted.
Yes, and that's actually something that I'll mention when we go through the public markets report as well, is that when you equal weight based on companies, often you get a very, very different valuation,
Yeah.
very different outcome than you do on valuation weighting.
Yeah, okay.
Okay. Any further questions from trustees? Any questions from the public, either present or online? Seeing none, we'll move to the next agenda item. Thank you.
All right. Next, we have the total pension plan performance report as of the end of September. The market environment, I think, has been quite surprisingly strong this year. If we take a look at the index returns here, just to sort of set the stage for your performance on page 5, you can see the quarter returns, so June 30th to September 30th on the left was surprisingly negative.
Yeah.
But then if you look at year to date, which includes the first 6 months of the year on the right, you have the S&P 500 up 10.7%. Quarter to date through yesterday, the S&P 500 is up another 10%.
Yeah.
So really staggering and positive returns, I think, and not what a lot of folks expected. If we look at non-US markets, they're strong as well, not quite as strong as the United States. Emerging markets up 5% since the end of September. And the aggregate bond index, which was quite challenged in a rising interest rate environment, has been up 6.5% since the end of September. So I know that your chief investment officer gave you, positive estimated returns for the fiscal year to date so far, but markets have turned around, I think, since the time period that we're looking at, this one negative quarter from June 30th to September 30th. I will take a look at the watch list. As you know, we put in our reports the watch list for any manager that is underperforming on a 3 or 5 year basis. So you can see that there are 3 managers currently on the watch list. We have some commentary about them as well. We recommend holding these 3 managers because all of them, if we look at different time periods or if we look at peer rankings, are still performing quite well. And of course, we don't base recommendations purely on performance, but this just does give us some comfort that even if we were to do that, these managers are not at risk in our minds. If we take a look at overall asset allocation, you can see that the total plan, the pension plan, stood at $2.8 billion as of the end of September. I will point out that public equity was underweight and private markets was overweight. You can see on the upper right by a few percent in each case, but the total growth assets were right at target, right around 75%. Total low beta, very close to target, and other here you can see was close to policy as well. The Russell overlay is an artificial way of getting the asset classes very close to their targets, even when on a physical sense they are not. Looking at performance, we have it here on the next slide. You can see for the quarter, as I mentioned, market performance was negative, but your plan protected value relative to every benchmark that we look at here, as well as the peer group, and ranked right around the top quartile of the peer group. If we look at the longer term performance, you can see that a double-digit return here for the 1 year period. The 3 year average annualized return also outperforming every benchmark that we look at, as well as the 5 year. If we do take the haircut for the fees that weren't included in the custodial statements, which we believe are about 10 basis points or less, the peer ranking then goes from 12th percentile to 15th percentile. So the 20th percentile is about 6.45%. So you can see that even if the return is 6.8, it's still well above the 20th percentile.
Mm-hmm. And we're going to hear more about the haircut later today, but at what point will the haircut numbers be integrated into your numbers?
Whenever the custodian bank, which is the book of record, updates their data, that flows through to our reports.
I see.
And we believe that's best practice to rely on the custodian as the book of record. We at Makita never believed that we'd try to cook the performance reports, but the custodian has
please
even
don't
less
say the
incentive.
word cook in open session.
Yep. The custodian has even less incentive than we do to make your performance look good.
Okay.
And so individual asset class wise, I'll call out, I think emerging markets equity has really shown recently. Your investment officer, Christina Wong, manages this asset class. And you can see that emerging markets equity, debt as well on the emerging market side, has been a disappointing asset class. I think from a fundamental perspective, growth in emerging markets is an attractive space to be in, but in riskier market environments or where the US dollar is strong, you see a lot of folks just selling off emerging markets whenever there's a blip in the market. However, the way that your investment team has implemented emerging markets has been much better than market. You can see here the emerging markets equity market as a whole for 3 years has lost an average of 30 basis points per year, and your fund's emerging markets managers have been up an average of 2.6% per year. And you can see the 5 year return as well has been more than double the index as a whole. One of the ways that your investment team has done that is by overweighting India and having some dedicated India managers. China has been a laggard, and so having less exposure to China in emerging markets has been quite positive for your plan. And you can see that the story on emerging markets debt as well, a 5-year average annualized return of 4.8% relative to negative 0.1% for the benchmark. So you can see that your plan's emerging markets debt exposure for 5 years has been in the second percentile, or the top 2% of the peer group. I won't go into individual managers unless there are questions, but I did want to look at the risk perspective on the portfolio, because we've just been talking about returns so far. So we have some charts starting, I'll highlight page 55. So this is looking at the 3-year trailing time period. And in the column on the left, we look at the annualized return for the 3 years. You can see that the total fund has been in the top quartile of its peer group. Then we look at standard deviation, and volatility-wise, you want these this dot and triangle to be above the line. That means less volatility than the peer group. And so then we look at the Sharpe and Sortino ratios, which are measures of risk-adjusted return. You want them to be higher, and you can see that they are well above the median for the 3-year period and top quartile for your fund on a risk-adjusted return basis. And we also have the 5-year period on the next slide here, where the numbers are even more pronounced in terms of top quartile performance on a risk-adjusted basis. So with that, I'm happy to answer any questions about your overall plan.
Okay, thank you. Any questions from trustees? Any questions from the public here or online? No? All right, thank you so much. Move to the next agenda item.
Okay, the last report that I have for you today is the Healthcare Trust, which I will share. You can see that the total current assets as of the end of September were $364 million in the Healthcare Trust, and you can see the current allocations relative to policy. And the strategy on the asset allocation for the Healthcare Trust is the same as the pension plan, taking into account that this fund needs to be more liquid and has a much lower level of assets. You can see on the next slide the performance. So I know we've discussed this before, but your Healthcare Trust is invested in a bit more risky way than many of the peer group health and welfare funds. I would say that most of these health and welfare peer group funds have a over 50% weight to fixed income. However, your Healthcare Trust has a target return that's quite similar to the pension trust, which has served you quite well over the long run, as you know, equity markets have done better than fixed income over the long time period that we look at here. And you can see that the 3-year return is in the top decile of the peer group at an average of 3.7% per year. The individual way that we express the asset classes and the managers underlying them are quite similar to what you see in the pension trust. So I won't go into detail there in the interest of time, but happy to take any questions.
Any questions from trustees? Any questions from the public? Thank you so much for the presentations.
Thank you. Happy holidays.
Happy holidays.
Thank you, Laura. So, Mr. Chairman, with your permission, 2F and 2G, we do need, sorry, 4F and 4G, we do need the board's permission. So when we move on to that, I would like to invite Jay Kwan and Ron Kumar.
Please.
The first one is the approval to renew the contract for Albon America. They are a data provider for our absolute return program, and the contract expires on December 31st. We are recommending a 18-month renewal to end the contract on June 30th, 2025 to align with the plan's fiscal year. The fee will remain unchanged at $60,000, and it includes a 7-day termination clause in case we decide to terminate. With that, I'll take any questions.
Are there any questions from trustees? Any public comment? So we need action here to approve
Yes,
the
please.
purchase.
Yes, please.
Do we have such a motion?
So moved, Mr. Chairman.
We have a motion from trustee Linder. Do we have a second?
I'll second.
We have a second from trustee Abbott. Any discussion on the motion? Hearing none, we will vote. Vice Chair Jennings.
Aye.
Trustee Abbott?
Aye.
Trustee Linder?
Aye.
Trustee Avasti?
Aye.
Trustee Faulkner? Aye. And I vote aye as well. It is approved.
Thank you. And the
Thank
second one is Dynamo Software, which is a cloud-based research management system that we use for manager research and oversight. And that contract expires on January 24th, 2024. We also trying to align this contract with the fiscal year end to end on June 30th, 2025. The annual fee is about $61,000 for 11 licenses, and it has a 60-day notice period for termination. And with that, I'll take any questions.
Are there any questions from trustees or from the public? So hearing none, do we have a motion to accept the recommendation?
I move we accept the recommendation.
We have a motion from trustee Linder. Do we have a second?
I'll second.
We have a second from trustee Abbott. Any discussion? Hearing none. We will vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Linder?
Aye.
Trustee Avasti?
Aye.
Trustee Faulkner?
Aye.
And I vote aye as well. Recommendation is accepted.
Thank you.
Thank you.
Yeah, thank you.
Okay, next, old business, there is none. We move to new business, an oral update from our CEO, Mr. Pena.
Thank you, Mr. Chair. A couple of issues. I just wanted to share with you the retiree open enrollment ended last November 30th. All open enrollment changes will be reflected on the paychecks for the retirees for the December payment to initiate coverage for January 1st, 2024. In terms of open enrollment statistics, the health fair was attended by close to 200 members. Over 880 open enrollment forms were received. About 60% of them were actually related to the in lieu continuation. That's when you're not really using the benefit, but you want a credit so that when you start using healthcare in the future, you have that credit. And the majority of those changes were actually, about 530 of them, submitted via the member direct portal. We actually had a very well attended health fair. We had stopped that during the COVID pandemic. We had it at the Lenin Center for the Federated retirees, where they usually have their meetings. And not only we have all the members, but obviously all the vendors as well. So great job by staff, by the way. I know it's a lot of work putting that together. We had our office quarterly staff meeting last month and updated the staff on the business of the Office of Retirement Services as well as the boards. Plus, we had some presentations from some of the charitable organizations that are part of the city giving campaign, so that the staff could make decisions in terms of if they were electing to make contributions to which offices to make contributions to. The office, we actually be closed just as most of the city during the last week of the calendar year, between Christmas Eve and New Year's Eve. Is the 25th and 26th, they're actually closed. The office is open from the 27th to the 29th, which is Wednesday, Thursday, and Friday, but it's a very limited number of staff. Some of them may be working remotely, some of them may be in the office, but it's somewhat limited. But we are open those 3 days, 27th, 28th, and 29th. Again, January 1st and 2nd, we're closed. We're back in business on Wednesday, January 3rd. Two more things, especially for the Federated employees. The 415 bill limit, which is the Internal Revenue Code limit, code that actually limits how much can be paid on an annual basis in terms of pension plan benefits. The amount went up for the calendar year 2024 from $265,000 to $275,000, a $10,000 increase. $10,000 increase. We will be with the cost of living that is due in April. We will be reviewing all those members that are impacted by the Internal Revenue Code 415 bill limit section and prepare the calculations and their letters accordingly based on this updated limit. Lastly, I wanted to share with you, I attended the city council meeting a couple of weeks ago to present the status report of the boards for the policies and procedures. The city council did actually accept the status report. There were very good questions. I'm sure Councilmember Davis will comment on it. So there were some concerns to the length of the sections that the board still elected to review. And so I made the point that the fact that they were reviewed further didn't mean that the boards were looking to relax or soften controls, but more than anything, they wanted to make sure that they work and allow our office to continue performing and provide efficient and effective operations of the office. And specifically, there were some concerns because there were quite a few items related to labor, which it was a point well taken, and some related to travel. The city council recommended that we keep apprised the Office of Employee Relation, and so I communicated with Jennifer Chambry and shared with her that we will certainly do that. Obviously, the city council prefers that we go back to the city council sooner rather than later. I explained the process that you boards actually are requiring your respective joint governance committees to do the review, and then once those meetings are completed, the items will come back to you boards for further review and action. And so we will certainly come back to City Council with the final result as early as possible. Didn't make any commitments, but did share that I thought it was more likely in the second half of the first half of the year, so meaning the second quarter. But rest assured that we will keep in mind the concerns by the City Council, and we will come back as quickly as we can. I don't know if you have any further comments, Ms. Davis, but that concludes my comments, Mr. Chair. Thank you.
Thank you. Any questions from trustees?
I have a question, but it's not about what's happening currently. And maybe this is something you'll tell us in the future, but one of the things that I know that a lot of the processes that are happening in ORS are very manual, and I'm wondering if going forward, and there was a report that we saw a few months ago saying that 20% of the retirees found it easy to find what they needed on the website. And I'm wondering if there's anything going forward that your team is looking at to automate the processes more or to improve the website. So, and it may just be a question for a future meeting, but I'm curious about that.
No, it's a fair question. I'll defer to Barbara, but before she speaks, so a couple of comments. We would like to automate as much as we can. And in fact, before you joined the board, we actually had a presentation. We had a strategic planning on communications. We actually hired a communications consultant, which we had shared with the board, and the board approved. So there's a strategic plan on that. In fact, that included at that time, we actually came out with what are the accounts? Facebook and Instagram.
X.
Correct?
Facebook and X.
And X.
X, yes,
Formerly known as
Twitter, X. I apologize. Yes, thank you. So my point being is that we are aware that automation is critical for the operations going forward, and in cases where we are able to implement those in an efficient manner, we will certainly pursue doing that. But rest assured that we do have a strategic plan which we presented twice a year, and so it's probably time to come back to you, board, and make that presentation again. But with that, I'll turn it over to Barbara for any other comments.
Yeah, additionally, we do have surveys on our Member Direct and our website, and we're always taking feedback and implementing any changes that would improve both of those. In addition, we are in the initial stages of exploring self-service, but of course, before we'd do that, we understand there's assessments going on currently for the network infrastructure, etc. So we're going to wait for the report or results from that before we would broaden our services. But we are hoping at some point to enhance and allow some self-service.
Okay, thank you. Any other questions from trustees?
Yeah, I have a question.
Go ahead.
So Roberto, how many days a week is the office open if people need to drop off paperwork or things like that on when we're not dealing with holidays?
So, Barbara, if I'm mistaken, please correct me, but we should be open Wednesday the 27th, Thursday the 28th, and Friday the 29th.
No, not the holidays.
So yeah, generally speaking, Trustee Jennings, we're open every day, 8 to 5. And I think CEO Pena was referring to our holiday closure
Yes.
period. But in general, which I think your question was, we're open every day.
Apologies, yes, we are. The door is actually closed, but they just have to knock on, we have a sign, they have to knock on the door, and we open the door for the members.
Okay, yeah, I think it was interesting. I was having a conversation with someone who is retired, and their partner is retired, and was mentioning that they had difficulty dropping off paperwork or stuff, and I wasn't really sure the exact hours or anything. So, and it could have been some prior time, who knows?
Yeah. Now, there's also a limitation sometimes, like if you're trying to get into the building before 7 a.m., you need a specific access card, and if you're coming in after
4:30, I think it is.
4:35 p.m., so if they tried those times, they could even get in the building unless someone opened the door for them. But again, our offices are open 8 to 5, Monday to Friday, except for holidays, obviously. Thank you.
Okay, any other questions from trustees? Any questions from the public here or online? All right, thank you, Mr. Pena. I believe next is an update from our City Council liaison, Councilmember Davis.
Thank you, Chair. We did have our last meeting of the calendar year last week, Tuesday, and we as Roberto mentioned, did hear the item about the policy update. The council did express concerns about the length of the list for the city policies that are under review, especially as Roberto mentioned, the employee issues, especially because many, if not most of all of the employees are city employees, and it's very important for us that all city employees are treated equally and are all following the same policies. The travel was mentioned as well as a couple of others. So very much also expressed interest in having this item closed and resolved as quickly as possible. So there really was a question if this could come back at least by April to the council for review, because we very much want to get this resolved before we get into too much of the budget, which takes up most of June, as you all know. So we would really like to have this resolved as quickly as possible, and with as many of the policies being standardized across the city, including all the departments, including ORS. And that concludes my update. Happy holidays, everybody.
Thank you. Any questions for our City Council liaison from trustees or from members of the public? All right, thank you very much. We'll move to item 6C. I believe our actuary is here. Discussion action on the final actuarial valuation.
Thank you, Mr. Chair. Jackie King is also with us online for this, and she will be doing part of this presentation. Let me bring up the... Okay. There we go. So we'll start off just with the schedule quickly. This is the final presentation on the pension side. We also have preliminary results of the OPEB valuation. And then we'll be back in January with the final results of just the OPEB. So we're nearing the end of your actuarial cycle here. So this is the final pension valuation results, and the primary thing we want to accomplish here is to take stock of what's happened to the pension plan during the year in terms of its funding, and then set contributions for fiscal year end 2025. So that's really the final numbers we're moving towards here. During the last year, items really progressed fairly close to our projections. So you can see the funded status improved from 57% to 59% based on the market value of assets and 58% based on the actuarial value. The liabilities grew. The liabilities are the bars. The dark blue are people receiving benefits, and the gold are people no longer working for the city but entitled to future benefits, and the red are the active members. So the asset level in those lines, both the actuarial and market, are very close together, so you can't distinguish the two lines, but there are not sufficient assets yet to pay for members who are in pay status. So it's a climb we've been on for a while, and we are making progress, but we still have not reached even that level. The right-hand side shows the Tier 1 versus Tier 2. Two quick comments on that. One, Tier 1 is where the bulk of the unfunded liability is. It's $2 billion in the Tier 1 side. Tier 2, however, for the first time, dropped below 90% funding. That's largely because of our assumption changes. We raised retirement rates and salary increases, and so that caused Tier 2 to drop down. They are on a 10-year amortization, so we expect that to be corrected relatively quickly, as opposed to the Tier 1 that's going to take longer to pay. But the other consequence of that, and we'll show you a little later, is Tier 2 costs are normally split 50-50. But there's a cap on how much the members' UAL rate can go up. And this is the first time the UAL rate would exceed that cap by just a small amount. And so the city's contribution is slightly greater than the members' contribution for the first time. Here's the aggregate contributions broken into pieces. The members are the light purple on the bottom. The city's normal cost is the dark purple. That's the cost of the benefits attributed to the next year's service. The little green slice is the administrative expense, and then the two gold pieces are the UAL payments. First, the interest on the UAL, and then the amount that's going to reduce the principal. The main thing I would take from this chart this year is we have the contribution rate going down as the contribution amount is going up. And what's happened is we had some significant growth in payroll, both salary increases and an increase in the number of active members. And so as a percent of payroll, those larger dollar amounts are actually smaller percentages.
On this chart where it says city admin, is that essentially the cost of the Office of Retirement Services? Or how might I understand that?
Yes, it's the cost of the Office of Retirement Services. It's the cost of our services, other vendors, and administrative services. It does not include investment costs.
Fees, yeah, okay.
we're actually, we have a couple slides on developing the actuarial value of assets. We're gonna, in the interest of time, skip over those unless you guys have any questions on them. The actuarial value and market value are virtually the same right now. And I'll turn it to Jackie to talk about the experience and changes in the UAL.
So this is the change in the unfunded actuarial liability. The graph on the left shows you the change over the last year. So it started at about 2 billion, and then you've got your contributions and your investment gains lowered the unfunded liability, but then the liability experience, mostly from salary, being higher than expected, and then all the assumption changes from the experience study, those increase the UAL a bit. The chart to the right shows the historical changes in it. So you can see there's a couple of prominent bars here. Assumption changes are the purple ones. A lot of that is attributable to lowering the discount rate over the last 10 years. And certain assumption changes like for mortality and stuff like that. The gold bar is for your investment gains and losses. So you can see that for most of the years, for 6 out of the 10 years, that increased your UAL. Another bar to look at is your the gray bar. Particularly that comes a lot from your salary changes and other demographic experience. The line is showing the net change in everything. So if you can see in the last 3 years, that net change has actually gotten fairly small and closer closer to zero, which is great because that means that you're kind of hitting your assumptions and you're not seeing as many gains and losses from that. The last one I wanted to focus on is the red bar. What that is the contributions and how they're paying down your UAL. So for the first 5 years of that period, they were adding to it, but you worked really hard, and now it's actually decreasing the UAL. So it's paying it down. So we just wanted to point that out.
So I just wanted to observe on that last chart, perhaps visually counterintuitive, that all that activity below the zero line, that's to the good.
Yes.
That's for the good. Yes, it's lowering it, yes.
Okay.
Yeah, it is counterintuitive. The UAL is up, and so, but we don't like the UAL, so.
Right, we don't like it at all. Okay. Please proceed.
Here, we just wanted to give you a couple charts for comparison on funded status. The chart on the left shows national plans from the public plan database. These are mostly large state plans, and the bars represent the range of their funded status. The gold diamond is San José Federated, and the black triangle is the combination of Federated and police and fire. So many of the national plans have a combination of general employees and safety employees, and so that gives you that type of comparison, but you can look at where your specific plan is. The chart on the right is the exact same chart, except we're comparing to just plans in California based on a Chiron survey. We look at 39 different plans in the state of California. On that one, you can see for a good period of time, the Federated plan was the lowest funded plan in the state. We've moved off the very bottom, but we're still among the worst funded plans in the state of California, and nationally, we're not well funded either. But we have a plan. And so the chart on the left here shows our projections of the actuarial liability. Tier 1 is in dark gray and Tier 2 is in light gray. And then the assets, which overlay each other right now, both green and blue lines, and the projection. So we're currently 59% funded. Over the next 20 years, the plan is to get to 100% funded. We know that experience along the way will make it much bumpier than this projection. It assumes that all assumptions are met as we go forward. The other thing I think is worth noting is even in 2043, we're projecting the liability for Tier 1 to be greater than for Tier 2. So Tier 1 is with us for quite some time. The right-hand side just looks at the actual unfunded liability and the projection to pay it down over time. This chart.
Hold on. Vice Chair Jennings, please.
Yeah. So when you were comparing to California, that's got CalPERS in there. Is that correct?
Yes. Yes.
And do you know where CalPERS falls more or less, at least in 2022?
I don't off the top of my head. I want to say that they're around 80, but I could be, yeah.
I think they're in the 60s.
Are they? Well.
Yeah. But that does.
CalPERS, yeah.
But that does raise another question. This chart, which is back on page 10, this is just looking at the number of plans. It's not weighted by the assets.
It is not weighted by the assets, no. And that's true on the national plans as well.
Okay.
It's not weighted by assets at all.
Okay, and the reason I ask is that, you know, CalPERS has a classic program, right? And so that's like our Tier 1 in a way, and then they, I believe, have the, you know, non-PEPRA that goes forward.
Yeah.
So you still have that same, you know, waiting for that active pay or the pay, you know, retirees to kind of, I guess, leave the plan, right, one way or another.
Yeah, most of the plans have something similar. This has for example, the 20 county plans are included in the survey, along with the city plans in San Francisco and LA and San Diego. So most of the plans have a Tier 1, at least a Tier 1 and a Tier 2, if not more tiers than that, and certainly PEPRA tiers, which are comparable in timing to your Tier 2.
And I just looked up CalPERS funding, 72%.
72 is 70, yeah.
Okay. Okay. So
The
that,
two of you. Also, you know, what was I going to say? If, it just went right out of my head, so sorry.
you can always come back to us, Vice Chair Jennings.
I can come back when we come
Okay.
back. Okay, yeah, thank you.
Well, I found the same information you did. You mentioned 80. I think it depends on the assumed rate of return that you use.
Yes, it does.
So, because I'm seeing conflicting depending on the assumed rate of return. There might be some low 80s if you use some high assumed rate of return. So, suffice to say they're higher than Federated, and they might be somewhere between the 70 and 80% range. That's what I can say.
Yeah, I would agree with that for sure. They're in that 70 to 80% range.
Yeah.
Also the discount rate. I mean, aren't some of these California plans that we're comparing that look so much better have a higher discount rate than we do?
Yes, but most of the California plans are at either 6 3/4 or 7.
Yeah.
So it would be interesting to see the same data on page 10 with the discount rates normalized.
And
to see
yeah,
how
we
we
can
really stack up.
Right. That would be interesting.
Well, we'll leave that as an assignment for
yes.
future presentations.
So we actually have that in the national data.
Oh, we
I
do?
don't know that we've built it into the tool for the California data, but we can. It doesn't move the California data a whole lot because their discount rates are so close. And even on the national scale, most of them have come down to around 7%.
Yeah.
And I think the median may even be slightly below 7 now.
Yeah, and I just looked
international.
up CalPERS discount rate 6.8% as of July 19th.
Okay, so they're still
6.8.
6.8% on the discount rate, so they're a little higher than us.
It would just be interesting to kind of know what they're doing that we're not, because I can tell you their salaries are higher than ours overall. You know, the county still pays more. So their wage increase might not be as significant, but that's because their salaries are higher. I mean, there's a reason why people are leaving the city to go somewhere else, because they can make more. They also don't have that 5% non-pensionable that we have. And so when people do leave the city, we have to now pay out at that, you know, we lose that 5% non-pensionable that we have. So it's just be interesting. I don't know if that's in a data comparison, but it would be interesting, right? Since we are at the bottom.
Yeah, so that kind of analysis is something we could do maybe for a retreat to understand kind of this history and how your history is different from some select other plans, if that's informative.
But I would like to mention something that you have mentioned in the past. I think since I joined this board, initially we were ahead of the curve on decreasing the discount rate, so that obviously we got below 7% a lot sooner than our peers. Now we have remained in that area between 6 and 5/8 and 6 and 7/8 for the last 5-7 years, but we got there really quickly when everybody else was about 7.5.
Yeah.
But what I wanted to say is specifically to Federated, and of course you are the actuary, you are the experts, so if I'm mistaken, please correct me, is that this board, many years ago, before I joined, for many years, all these plans, they had a 30-year amortization that was called a 30-year rolling amortization, meaning every year the liability was amortized over 30 years. So when the downturn came and the funded status were impacted, that practice was sort of somewhat stopped, and this board elected to then go from 30 years, from the 30-year rolling amortization to 30 years fixed, and then 29, 28, 27. What that meant was that for about the first 7 years, between the 30th and the almost the 23rd year amortization, the contribution that was calculated for payments by the city was not enough, assuming everything else equal, was not enough to actually pay down the unfunded liability. Is that a fair?
Yeah, so there.
So everything else equal, the funded ratio continued going down because there was not enough. There was enough to meet the calculated payment required as calculated by the actuary, but because the amortization was still so long, it didn't include enough of a payment down on the unfunded liability to start just taking away that unfunded liability. So you can explain it better than me, but that's basically the concept.
Yes, so back in 2009, you were still using the rolling 30-year amortization method as a level percent of pay. What Jackie was talking about here with these red bars, it is the end of that transition away from that. So we fixed the amortization period at 30 years instead of letting it roll in 2009, and then have made shorter amortization periods since then. And so as that 30-year amortization has gotten shorter and shorter, we switched from it not being enough to pay anything down on the UAL, not even the interest on the UAL, to in 2019, we finally started paying down the UAL with the contributions. And so that was a critical change that was made. It takes a long time to turn the oil tanker, so to speak. And so it has taken a while. And this, if you look at this chart, is showing the individual pieces, individual layers of our amortization. So each year when there's a change, we amortize that change. That light red layer is that 30-year layer that was set in 2009. That is the bulk of what we're trying to pay down. And you can see it goes out to 2039, and then we have a significant drop in our contributions. So that really was a big part of the history of how we ended up here. I would say, Jackie pointed this, and we don't go back quite far enough on this chart. We only go back to 2014. But those assumption changes that you see early on, those were bringing down the discount rate, but there were a bunch of other assumption changes that we felt had to be made to really strengthen the assumptions for this plan. And so those added quite a lot to the actuarial liability early on, and that drives your funded percentage down. But it puts you on a much more realistic path going forward. It's just when you're starting at 50 to 60% funded, it's going to take a while for us to climb out of it. And so that's what this part is showing. You can see on the left graph in 2018 where we're 50% funded, and it's our contributions are relatively high. You know, if we wanted this to go faster, we can raise the contributions higher, but there's always the issues of managing that load on the city at the same time that we're trying to pay it off. And so we've kind of found this this medium position where we think the rates are high enough, we're paying down the unfunded, we have a plan to get there, but it's not going to be there in 5 years. It's going to take a while.
What year was it when we changed from the 30-year amortization?
It was 2010, I think. So we froze the 29 base and made it a 30-year base and started fresh from there.
And then in 2010, we made it, is it what, 10 years?
20-year amortizations.
20 years, okay, I always get confused between. So then we changed it to 20-year amortization.
Right. So, I mean, it might be good, especially with all the board turnover, to revisit all that history at some point and kind of walk you through what the changes were, when, why, and sort of how the ship has turned, and then where we're going from here. But
I think that's important. I'm sorry, you know, because a lot of times when I'm listening to this, and you know, I'm a city employee as well, and I'm a tier 1 employee, it's like, oh, it's tier 1, they're doing this to us, or oh, it's the salary increases that we like justly gave employees. You know, I mean, it just seems like, you know, that's an easy way to pigeonhole this and why we're so low. And, you know, I don't know if that's truly accurate. You know, I mean, I'm sure it all has impact, but, you know, I just, it always kind of raises my back a little for those things. And I don't know if that's truly what's driving this to this level. And I think we need to keep on saying that. Otherwise, it creates a picture that might not be the one we want to go forward.
I think it's certainly important to have an historical view, so maybe we can have a study session where we go back and look at some of past decisions. And also governance has changed for the pension board, and a lot has changed.
yes.
But I do take some heart in the graph on the right side, which shows that our UAL on a dollar basis appears to have peaked and will begin to decline increasingly rapidly as the years go forward.
As long as we meet all our assumptions.
Of course.
Big salary increases. I have a question, just for my edification.
Sure.
How young are the youngest people in tier one that are retired.
Oh, that are retired.
Yeah, so that we're paying benefits to, I'm curious.
Jackie, can you look at the report?
I mean,
So
we can speak of the benefit structure, how it works.
That you can retire, if you have 30 years with the city, you can retire at 50.
At
If
50?
you have
Okay,
less
they can be
than
pretty
30
young.
years, you can retire at 55. And there are a number, and you also at that, then you need 15 years with the city in order to get medical.
Right.
So if most people, if they have families or whatever, want that 15 years.
Yeah.
They tend to, but that would be, at this point, the youngest, in my opinion, because, they retired sometime this year.
Yeah, not
That's
counting
what
survivors.
That's for
So,
Yeah.
tier one, right, Julie?
or disabilities.
Yes.
Tier 1.
Yeah,
Fair point. No survivors. It's just the actual member, because
yeah,
you can have survivors and members pass away, and you can have kids that are in their teens, and
Sure.
you're paying them. But I think generally speaking, I think your question was not who's the youngest, but generally speaking, like how young can they retire?
yeah,
Early 50s, early to mid 50s. I mean, tier one. If they want to get a sizable benefit, meaning many years of service, started working early and everything else, I would say early 50s.
Yeah.
But I mean, that's not the bulk of them. I mean, you have the data, I don't. So.
Right, or they do a deferred retirement. I mean, a lot of people, 50, 55 is pretty young to
Yeah.
retire, in my opinion. So then they defer and don't draw on their retirement, and then they go work for the county or Milpitas or, any of these places. They make more money, and then they work another, 10 or more years, and then they get paid out
yeah.
of our retirement system at that highest salary. And that is how they get rid of the 5% non-pensionable.
So I would just say, on the agenda, there were 3 documents. I'm only going through the PowerPoint, but there's a final report on the experience study and a final report on the valuation. There's a whole appendix in the valuation report that goes through the census data and breaks things out by age and service. And so you can get to a lot of those questions looking through those tables. And then we're happy to go through it with you as you wish.
Okay. Please proceed, Mr. Hallmark.
Okay, these are the projections of contributions. Chart on the left is the rate. Chart on the right is the dollar amount, breaking between the member and the city. The dark blue line is what the projection was last year. Again, it's interesting to me that the contribution rates are lower than we projected last year, but the dollar amounts are higher than we projected last year. And so that's consistent with that story of we have expanded the payroll both through the number of active members and the salary increases. And so that's driving that dynamic. And you can clearly see on the dollar chart after 2039, when we pay off that 2009 UAL, that we have like $150 million drop in the contribution. So we will probably want to do something before we get there so that we don't actually go off that cliff, that it grades down over some reasonable period, but we don't need to do anything now on that. So we wanted to quickly hit a couple things about the plan. Those are the main results, but we want to hit a couple things here. I'm going to let Jackie talk about tier 1 versus tier 2.
So these are showing, the graph on the left shows your member counts, and on the right it's the payroll. So everything in blue is tier 1 and everything in green is tier 2, and it's broken down a little bit by status too based on the shade. But what you can see is on the right there, you can see that tier 2 is now making up 68% of the payroll compared to tier 1, which is only 32%. So you can see how the tier 2 is growing. Well, what I'm going to do is then switch to, so bear in mind, it's a lot of your payroll, but now if we look at it as a portion of your liabilities and your assets, tier 2 is still very, very small. It's growing, but it's still a very small fraction of it. Tier 1 still accounts for the majority of the liability and the assets. This one, we're showing you the comparison of the dollar contribution amounts. So the key thing from here too is if you look at the tier 1, that city UAL payment is still the biggest bulk of the contribution that's getting paid. So it accounts for about 75% of the city's contribution and 65% of the total contributions coming in from the city and the members. Your tier 1 normal costs, it's expected to decrease as members retire and you have fewer actives there. But there was an increase this year, and once again, we're going to tie that back to the increase in the salary is what caused that increase. It wasn't an increase in the population, which is decreasing for tier 1 active population. Tier 2, your contributions are increasing as your payrolls increase, and as Bill mentioned earlier on, there is a limit on the member contribution, the UAL portion of their tier 2 contribution amount, and that did get applied this year. And what that is just that portion of the contribution can't increase by more than 0.33%. So, with that.
So every year with the valuation, we have a section on the maturity of the pension plans. And the reason we want to talk about it is that unlike a mature person who you think of as level-headed and all, a mature pension plan is the opposite. It's very sensitive to any changes. You don't want to prick the mature pension plan. Now, we make a big deal out of this at the police and fire meeting because they have one of the most mature plans around. Federated is mature, but much, much less mature. So keep that in mind. We'll just touch on it for you to keep in the back of your head about the sensitivity of the plan.
Yes, I agree when you compare the siblings, right, police and fire and federated, but since, trustees ask questions and always compare themselves or the plans to California, when you compare our plan to other California plans, I mean, federated, how mature are we compared to our peer systems across the state?
So do we just have the national. We didn't put the California one in here.
You mean you don't know by heart
off
all
the top of my
systems in
head?
California?
I think you are. I think federated is probably above the median.
Okay, that's my point. Yes.
But probably not too far above the median in California.
Thank you.
Yes, I just looked at some of the statistics, and you're very close to the median.
So Jackie, did you want to do this one or you?
So one of the measures that we look at when we're looking at maturity of the plan is called the support ratio. And what that is the ratio of your inactives to every active that you have in the plan. So this graph shows the historical counts by status, and then the red line is that support ratio. So as your plan matures, you expect that support ratio to tick up as your ratio of your inactives to your actives, because you kind of assume a stable active population, but you expect your inactives to keep increasing. You did see a decrease this year, and that was due to a nice increase in your active population. If you look at the two bars at the bottom, the blue, you're almost up to the level, your active count from 2009. Yeah, that big decrease has been creeping up. So that accounted for the decrease this year. The next measure for maturity that we look at, we call them the leverage ratios. So there's the asset leverage ratio and the liability leverage ratio. And what that is your market value or your liability compared to your payroll. So kind of in a nutshell, the higher the leverage ratio is, the more susceptible you are, the more risk you're taking on. So for assets, the more risk you take on for investment losses, and for liabilities, for changes like assumptions and stuff. So what these graphs show you is, the distribution, and these are from the national survey, not the California survey. And you can see for the Federated plan by itself, on the left, for the asset leverage ratio, you're fairly close to the median, but when you count police and fire in with Federated, so the total San Jose, which is the black triangles, you can see how much higher it jumps up. So as Phil mentioned, as a whole, the two plans together are very, very mature. Federated by itself is mature, but not as much as police and fire. And for the asset leverage ratio on the right, you're above the median there, but not as above it as police and fire is.
So the way to think about the asset leverage ratio and why it's important is if you had a 10% loss on your investments compared to the assumption, not just minus 10. If your asset leverage ratio is 10, that's equivalent to 100% of your payroll. And so you're going to spread a cost equal to 100% of your payroll over 20 years in our amortization. If your leverage ratio is only 6, that exact same investment loss is only 60% of payroll. And so the impact it's going to have on your contributions is going to be dramatically less than if it was 10. And so that's the dynamic that's being captured here. It's not to say that if you are 10, you don't take any investment risk, because you're going to need to look at those risk-return trade-offs. But just understand that it's going to have a more dramatic impact on your contributions due to investment volatility. It's not just losses. Gains also are exaggerated. So it just creates more volatility.
So is there a point at which, sorry.
Go ahead.
Is there a point at which you need to be less risky because of that? That we should be changing our asset allocation as we get to a certain level of maturity?
Well, theoretically, there's a point. Finding where that point is and how much is a very difficult and subjective task. So I think the other aspect of it here is if you take a more conservative asset allocation, then your expected return goes down.
Yeah.
And so then your discount rate goes down. And so now you're targeting a higher liability, so you have to pay more upfront. So it's that risk-return trade-off you have to balance. And so here we are showing the current discount rate of 6.625 plus and minus 100 basis points. And then last time we talked that we're now required to show this low default risk measure, which the index for it is 4.9% this year. And so that difference is 6.2 billion in liability versus about 5 billion in liability. And so you can think of that 1.2 billion as the expected savings from bearing the risk of your current investment policy. Or you can think of it as the cost of eliminating that. So there is a cost if you try to take that down.
Police and fire, are there
Their asset allocation, if I remember, is it 70% equity and 30%?
It's slightly more conservative than Federated. There's about 5% less in growth assets for police and fire.
Okay. And they're the ones that are much more mature than we are. So, and since each board does an asset allocation, right? What we would do is control our piece of it.
Right,
Yeah,
right.
yeah, that's right.
Yeah, so this is a much more significant issue for police and fire than for Federated.
And just going back to the previous slide, it looks like there was a notable jump in the asset and liability leverage ratios in 2011. So what happened in 2011?
We cut payroll.
Okay.
Okay,
I thought that happened in
We had
2010, but I guess
a
the result.
reduction in pay, and I think if I go back one more,
Yeah.
you can see the reduction in the active population,
Yeah.
and there was a reduction in salaries.
A lot of people retired. That I love to say.
Yeah.
So now I do want to emphasize here, we use payroll as the denominator, but payroll is really a proxy for the sponsor's revenue or budget, and less just about pay. You can't, and we do that because if we could come up with a revenue or budget number for the city of San Jose, but to go back to the prior example, try coming up with that for CalPERS, because of all the different employers involved and their different sources of revenue and stuff. So for these kinds of comparisons, we use payroll as kind of a rough proxy of the resources available to the plan.
Okay.
So it's not just you give everyone a 20% pay increase and things look better. It has to be supported by the revenue behind that.
Okay. Thank you.
I won't go through these in particular, but we wanted to give you a sense of how things would change on the contribution side if you change either the discount rate or if you had a really bad investment return. The right-hand side's looking at the investment return, and I would just note that's the first year impact. We smooth that investment return over 5 years, and so you're going to have a similar impact the next 4 years. We have a number of projection scenarios. I'm going to kind of orient you to them, but not go through them, and then take any questions. The first one is looking at the aggregate contribution rates and what happens. We generate 10,000 different investment scenarios based on the capital market assumptions, the expected return, and the standard deviation, and look at how those contribution rates play out. So the bars run from the 5th percentile to 95th percentile of potential contributions. There is a wide range of potential outcomes. It's definitely not anywhere near as wide as police and fire, but it's still a wide range. This slide is looking at it by tier as a dollar amount. And so you can see the issue for volatility is still tier 1. Tier 2 is small and growing, and so there's very limited volatility on that. Here, we're just looking at the projection of the unfunded liability. We had that nice chart showing it going down, but there's variability around that. It does look like there's kind of a cap. That's because if you have bad experience, we raise contributions. So there is kind of a cap because we assume you can pay the higher contributions to do that. There is a possibility of being more than 100% funded. It's not a high possibility, but it is there.
It's good to know it exists.
The right-hand side is just showing by year the probability of achieving either 80% funded in blue or 100% funded in green. And so you can see those probabilities increase over time. Now we developed some scenarios so you can get a sense of, on a simplified basis, what happens in different scenarios. They're built off the capital market assumptions, which this year are much more optimistic than they have been in the past. They're not intended to be realistic, but to just give you a sense of the volatility. The left-hand side shows the city aggregate contribution rates. The right-hand side shows the impact on Tier 2 member contribution rates. And I just want to caution you, we've zoomed in on that. So it looks like the Tier 2 member contributions are volatile, but the entire scale covers 1.25% of pay. So just keep that in mind as you're looking at that. And then I want to end with this. This is a cheat sheet we're giving you, essentially, to look at what next year's contribution would be under any investment return scenario for the coming year. So the x-axis shows investment return for fiscal year end 2024 ranging from -15% to +30%. The blue line is the 2025 contribution, which is locked in, and the green line is how it would change for 2026 based on those investment returns. Left side shows percent of pay, right side dollar amount. And so when Prabhu gives you the update about where you are, you can kind of look at where we expect you to be in terms of contributions for the following year. So with that, we'll take any other questions you may have.
Thank you very much. Any questions, further questions from trustees?
A lot of information.
So especially appreciate the sensitivity analysis. Any question?
I have a question.
Go ahead, please.
I'm looking at the appendix, and it seems like the contribution rates for Tier 2 are increasing. Is that correct?
Yeah, so the contribution rates increased this year for fiscal year in 2025, and then they are projected to actually decline.
And I understand that there are multiple factors which are contributing to this increase. But if, for a layman, if one has to list the primary factors for this increase just in Tier 2 and not Tier 1, what can those be?
Yeah, I don't have the cheat sheet in front of me, but we changed some assumptions which had a much bigger impact on Tier 2 than Tier 1. The big one, I believe, was the retirement rates, because we had been using some rates from CalPERS because we didn't have any Tier 2 experience, and this year we had Tier 2 experience, and it showed much higher retirement rates for the people who've retired so far. There's not a ton of them, and so we increased those retirement rates, which increased the liability. There's also the salary increases had an impact there as well.
Okay, thank you.
Any other questions from trustees? Any questions from the public, either here or online? Okay, it appears there are none. Let us move to the next presentation.
So this one's for discussion and action, so we
Oh, I'm
must
sorry.
approve it.
Okay, thank you for reminding me of that. So we need action to accept the final valuation report. Is that correct?
Correct.
So do we have a motion to accept the report?
So moved, Mr. Chair.
To accept the report.
Okay, I think I heard trustee Linda first, so I'm gonna give him first motion, and it sounds like Vice Chair Jennings is a second. Is there any discussion on the motion? Any public comment? We can vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Linder?
Aye.
Trustee Avasti?
Aye.
Trustee Faulkner?
Aye.
And I vote aye as well. The report is accepted. Now we're on to preliminary results for the OPEB. And I believe it's still Mr. Hallmark.
Yeah, let me get. Okay, so we have Mike Shunning online and Taylor Stevens here with me. First, I want to announce that Mike Shunning is retiring, and I think it's January 12th. Is that your date, Mike?
Yes, that is the date.
So just before your next meeting. So Mike has been the health actuary on this for quite some time, and we've really appreciated his work. Taylor is going to be stepping in and taking the role of the primary health actuary. We have a team of people though, so the rest of the team is not changing. And so we just want to wish Mike well, and we'll go through the preliminary results here.
Okay. Thank you.
So the OPEB valuation is very similar to the pension valuation, but there are a couple things I want to point out that are different. First, there are two different subsidies. There's a premium subsidy, which we call the explicit subsidy, and that's the focus of the funding and really the focus of most of our presentation. We also disclose an implicit subsidy that the city pays on a pay-as-you-go basis through their active health premiums. And so that's really a part of the liability for the overall plan. We disclose it, but it's not part of the pre-funding strategy, which is what we're really focused on. The other piece is that member contributions are fixed for this plan at 7.5% of pay. So the changes we make do not affect member contributions, unlike on the pension plan where when we make assumption changes or other changes, it can affect member contributions. The last thing is this plan is largely closed. So there's a closed group of people who are entitled to full benefits, full retiree medical benefits under the plan. Everyone else is only eligible for a catastrophic disability benefit. And so that's much, much less expensive. And so we have a different dynamic because of that. And then I'll mention one other difference here. The left-hand side, we're showing the liability just like we did on the pension plan. I do want to point out that the total liability for the explicit subsidy is $630 million as opposed to about $5 billion for the pension plan. So we're dealing with a much smaller liability here. On the funded status side, you can see that both assets and liabilities went up, but liabilities went up by at a faster pace than assets. And so the funded status dropped slightly from 60 to 59. That's translating on the right-hand side on the contributions. We have the member contributions in purple and the city's contributions in gold. And those contributions are higher than we expected in the prior valuation, which is shown by the blue line. The other thing I'd note is the normal cost is the cost of the benefits attributed to the next year of service. The member contributions are paying more than the full normal cost. So member contributions are paying down a part of the unfunded liability, and the city's contribution is entirely going to the unfunded liability.
So this offers a view of membership over the last several years. Just looking at the change from the prior valuation, active membership is up about 6.6%, and among that group that's eligible for full benefits, continues to decline and is down 6.8%. The group that's eligible for catastrophic disability only is up 13.5%. We look at members who are receiving benefits. The non-Medicare eligible population continues to decline, while the population that's eligible for Medicare continues to increase. So this again offers a view of that increase in the actuarial liability as well as the smaller increase in assets. The increase in the actuarial liability, we'll get into it on the next slide, but is largely driven by the higher premiums that we've seen. And as Bill mentioned, the difference in the increases causes the unfunded actuarial liability to increase. So this is a view of that change in the unfunded actuarial liability, similar to it's largely gone the other way, where premiums have been lower and have actually been lower than our expectations and decreased the UAL. In fact, over the full 5-year period, the liability experience has decreased the UAL $93 million.
I have a question.
Yeah.
When does the liability decrease when the people on this plan reach Medicare age? You know, they start claiming that.
No. And we'll show on another slide how much essentially the benefits are less per year, but it's over a longer period of time. So the Medicare eligible period for a member is longer than their non-Medicare eligible period.
But also the liability is anticipating them going from pre-Medicare to Medicare. So it's the liability itself is sort of a present value of all those future payments.
But once they reach Medicare, it's less of a cost to the plan, right?
The annual payments are lower.
But it's already known and baked into the numbers, so it's not a,
baked into it.
yeah, so it's not a
The
change in
reality
liability.
of the day-to-day is it's less if they're on Medicare.
The
I guess that was my
the
question.
annual payments are less.
Pardon?
The annual payments to the individual are less.
To the individual or to the plan?
No, from the plan for the premiums. The annual payments are less when the individual's eligible for Medicare. But that doesn't make the overall liability less.
So looking at it from the perspective of an individual retiree, the amount of money that needs to be set aside for their health care goes down once they're Medicare eligible. But looking at it from the perspective of a plan, it's already known who is what age and when they will retire, and it's already baked into the numbers. So it's not a net change in liability from one year to the next.
Right. And then the other piece, which we will get to, is that overall the liability for Medicare eligible health care is the largest part of your liability. And that's, even though it's a smaller amount each year, what Taylor was saying is you're paying it for a much longer period of time than you're making the pre-Medicare payments.
Okay, understood.
So I think we covered.
I think we covered this.
So, yeah, this is where we break the source of the liability out. And so fully 50% of the liability is already for people who are retired, receiving payments, and it's for their Medicare eligible payments. The lighter blue shows the in-pay pre-Medicare liability is about 10% of the liability. So 68% of the liability is people already receiving benefits. Similarly, just by coincidence, 60% of the liability is attributable to payments we expect to make for medical benefits after they're eligible for Medicare. So you've got that dark red or almost brown color showing active members. They're not currently eligible for Medicare, but that's the liability we are showing for when they are eligible for Medicare, for the payments we expect to make when they are eligible. So just to wrap up, these are the contributions. The member contributions are actually going up, which is very unusual because it's a closed group and the count is going down, but that's the impact of the salary increases. The city's contribution goes up about 1.3 million. The city here does have an optional cap that they can impose, but that cap is far above the current contributions. So it really does not come into play and has not come into play for the Federated plan. And then we estimate the implicit subsidy payment they're making to increase to 6.8 million. So that's all we have for you today. We'll take questions. We will be back with the final results here, which should largely mirror these, but we may make some refinements.
Okay, and we very much look forward to that. Are there any questions from trustees? So I have a very specific question on both this presentation and the previous one. We have discussed contributions from the city and from employees for both the main pension and OPEB. And as I believe you're aware, and we're about to discuss in the next agenda item, there has been an issue of the undercount of some investment fees that have affected our calculations of investment returns. Does that affect your calculation or the actuary's calculation of contributions in any way, past or present, for the city or for members?
Based on my understanding of what's happened, it does not. Our calculations are based on the audited financial statements and the dollars. Any reporting of historical returns is sort of irrelevant to our calculation. It's not entirely irrelevant. We like to look at the numbers, but it does not come into our calculations at all. So as long as the audited financial statements don't change, there's no change to our calculations.
Okay, thank you. Any other questions from trustees? Any questions from the public? So this is just discussion and preliminary results, so there's no action required.
Correct.
So with that, we thank you, Mr. Hallmark, and the rest of the Chiron team, and wish you a happy holiday.
Happy holidays to you as well.
And happy retirement.
Yes, I know. And hopefully he has a pension. So we changed the order of business. We're going to take item 6G next, I believe. And this is discussion and action on the Messias, Ginny, and O'Connell agreed-upon procedures report. And who will be presenting on that?
Yes, thank you, Mr. Chair. Craig, did you join us remotely?
Hi, Roberto. Yes, I'm here.
Yes, hi, Craig. So Craig is the partner in charge not only of the audit, the financial audit of the Office of Retirement Services by Messias Gini, but also for the agreed-upon procedures for this specific item, which was a very specific procedures and review that was requested as Messias Gini, dealing with, you just questioned, Mr. Chair, regarding the management fees and the calculated returns of the plan. So with that, I'll just turn it over to Craig for his presentation on the report. Welcome, Craig. Good morning.
Good morning, Roberto. Thank you. And morning to all the trustees. As Roberto mentioned, I'm a partner with overseeing all of our engagements for both Federated and police and fire plans. And due to the issue with the management fees, management reached out to us and engaged us to perform what's called an agreed upon procedures engagement. Now, agreed upon procedures, just for those that don't know and to go back over it, it's not an audit. It's not we don't provide any assurance over it, but what we do is we agree to perform procedures that management comes up with, gives us the information, and then we go and perform the procedures. In this case, to assist both boards into evaluating what would happen if we included the invoiced management fees that aren't in the, as we understand, aren't in the custodian bank and then the consultant's records, and what that impact would be on the reported returns over the periods from June 30, 2015, all the way through June 30, 2023. And so we performed our procedures. We we obtained the market values from the bank and from the consultant reports over the time period. We obtained the general ledger transaction details of all the invoice management fees, and then we performed the calculations to estimate what those missing fees impacts would be on the returns for over the different time periods, and we've got those laid out in our report that everyone should have a copy of and attached to the agenda. Overall, we found that the differences in the returns, and this applies to both Federated pension plan and the healthcare trust fund. The differences were between 2 and 12 or 13 basis points. It would change the reported returns in the investment consultant reports. So with that, I'll take any questions.
Okay, thank you. Are there any questions from trustees? Any questions from the public? Okay, so we have action to approve this report on agreed upon procedures. Do we have a motion?
I so move.
We have a motion from trustee Abbott. Do we have a second?
Second.
We have a second from trustee Linder. Any discussion by trustees? Any comment from the public? Hearing none, we'll vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Linder?
Aye.
Trustee Avasti?
Aye.
Trustee Faulkner? Aye. And I vote aye as well. The report is accepted. Thank you. And then according to orders of the day, we were also going to take Audit Committee item 7.2B now. Is that your intention?
Yes.
Okay. So if we can flash forward to 7.2B.
So before we hear that item, I just want a housekeeping matter. Before the board hears the ACFR item up for approval, I did want to note for the record that the attachment of the proposed ACFR that was posted with the agenda has been superseded by a revised version of the ACFR, which we are making available to the board and the public at this board meeting. Hard copies of the revised ACFR, subject to the board's approval today, are available at this meeting in hard copy. And if you would like a copy, please raise your hand and we can provide one to you. The revised ACFR has an updated disclosure language with respect to the total returns, which have been reviewed by the chair and the audit committee, chair of the audit committee, that incorporates MGO's agreed upon procedure report that the board had just previously approved. Thank you.
Great, thank you. And so this is the ACFR for anybody who wants to refer to it. It's the big document. So we don't know if there's any further presentation or discussion on the ACFR. There was considerable work this week to approve the footnote, which is highlighted in blue, which draws attention to the issue that was just clarified by the MGO report about the undercount of fees. So we now have numbers that reflect most comprehensively the fees that have been paid and the investment returns that have resulted.
Well, one clarifying question. I'm not sure if the version that was posted did have the highlights. Benji, could you please, I'm sorry, the version that was printed out has the blue highlights in it. And so if you would like me to note for the record where those disclosures are, I could certainly do that.
If you feel that's necessary,
It's up to the chair.
Mm-hmm. Yeah, let's do that.
Okay. So there are two footnotes that are in the ACFR reports. One of the footnotes is the disclosure explaining that the certified audited financial statements statement of the total return fees are based on ORS's general ledger. That footnote is found at PDF page 79 of the document in the audited financial statement section. The other disclosure is regard to the total investment returns percentages, which is based on MGO's audited or agreed upon report, which MGO just presented, and that is found at PDF pages 111 through 13, page 28, page 81, 88, 123, and 124, and 127.
Thank you. And I'm looking online, at least on the version I have, that the attachment that is posted did not have the most updated footnote language.
That's correct.
Okay. Okay.
So the version subject to the board's approval is the hard copy provided to the board here today and made available to the public.
Okay. So with that, are there any questions from trustees or the public on the ACFR?
And the difference between the soft copy and the hard copy is the footnote and the updated investment return percentage. Right?
Correct. So in the difference between the online copy that was posted with our agenda and the hard copy that's provided to you is the footnote language on the pages that I've cited, as well as we have now included a copy of MGO's agreed upon procedures report that should fall behind the
The report on investment activity.
It was following behind the report, Makita's report on investment activity. I believe it's on page 83 is where it commences. 82.
Okay. And the footnote that appears throughout is exactly the same.
No, the version of the footnote that's provided with the agenda copy is different from the version in the printed copy provided to you.
Right, but within, it's consistent within this document.
Correct.
Okay, that's what I'm saying. Okay. All right, with all of that clarified, are there any further questions from trustees of the public? And if not, do we have a motion to accept and approve the ACFR for the past fiscal year?
I so move.
We have a motion from trustee Abbott. Do we have a second?
I second.
We have a second from trustee Avasti. Any further discussion on the motion? Any public comment? Vice Chair Jennings, how do you vote?
Aye.
Trustee Abbott?
Aye.
Trustee Linder?
Aye.
Trustee Avasti?
Aye.
And trustee Faulkner?
Aye.
And I vote aye as well. The ACFR is accepted. Okay, now we move backward
This definitely will help.
to item 6E. Discussion and action on election of the board chair. So this is our last opportunity to reconsider the path we appear to be on for this year in electing a board chair. So it is still possible, I believe, for other nominations to come forward. Is that correct?
That is not correct. So at this meeting, the nominations have already been done. At this meeting, the nominee for both vice chair and chair must accept or decline their nomination. And once accepted, then we would go ahead and vote. And the election must be done by an affirmative vote of 4 members for it to take effect.
Meta, can you repeat the nominations? I was not there in the last meeting.
Sure. So the nomination was Chair Horowitz to continue in his position, and then Vice Chair Jennings to continue in her position.
Very good then. So I guess then the next item is simply it's not, is it a motion or simply a vote?
It's a vote. So first, Chair Horowitz, I believe you accepted at the last meeting, but just to confirm, are you accepting your nomination as chair?
I guess I am.
Okay. And then we would go ahead and vote.
Okay. I guess, and we have to have a roll call vote.
Correct.
So Vice Chair Jennings, how do you vote?
Aye.
Trustee Abbott?
Aye.
Trustee Linder?
Aye.
Trustee Avasti?
Aye.
Trustee Faulkner?
Aye.
And I think I will abstain in the interest of impartiality.
Congratulations, Chair Horowitz.
Yeah, okay.
Well, we actually really need you with the transition right now.
Mhm.
These 2 key issues we've been working on.
We do have a number of balls in the air, that's no question. So I guess the same procedure now for the vice chair.
That's correct. So Trustee Jennings, do you accept your nomination to continue to serve as vice chair?
Yes, I do.
Okay, we will have a vote. Vice Chair Jennings?
Oh, I guess I'll abstain.
Okay, Trustee Abbott?
Aye.
Trustee Linder?
Aye.
Trustee Avasti?
Aye.
Trustee Faulkner?
Aye.
And I vote aye as well. So our leadership team remains in place.
I have a question. What would happen?
Thank you for your
if
service.
there was if someone declined the nomination?
So we have a board election procedures that
Mhm.
would fall into play. If we did not have a vote in place or someone declined, then we would then go to, hold on a second, let me just look right here.
Generally speaking, they will have to choose one.
Right, I believe there is a procedure that we select one at random, I believe, but I would have to double check the policy.
Okay, so it's not a modified version of the Hunger Games.
Right.
So whoever's not at the meeting might get.
That's right.
It is a big incentive to show up. As they say, 90% of life is just being there.
That's right.
So I believe we are on to committee reports now, 7.1, Investment Committee. The chair of the Investment Committee is not currently present. We did have a very nice review of private markets and a number of other items. But I guess we have to simply accept minutes from the Investment Committee, is that correct? Does that require a vote, or that can be done?
No, that's receive and file.
Receive and file, very good. Then we're on to the Audit Committee, oral update from the chair of the Audit Committee. Do we have a report from our chair?
The last meeting was on October 19th. I wonder if the board was updated of that meeting in November, because I wasn't there.
Yes,
right?
we
So
probably
I
did.
don't think I have any more updates. The next meeting is
Okay,
on February
great.
15th.
All right, thank you. Then on to 7.3, Governance Committee, oral update from the chair of the Governance Committee.
We met as a joint governance committee with the police and fire
Mhm.
recently, and we're working our way through various policies, as has been indicated by the council and others. Maytech has been trying to lead us through the policies that we need work on. And we've agreed that travel is one of the big ones that we want to deal with. And
Can you speak more into your mic? There's spotty.
Pull it
yeah, I've
over.
been trying to avoid speaking more. No, I was just saying that we've met in joint session with the Police and Fire Governance Committee. And we've been working our way through policies that we need to update or leave the same or radically change. And one that really has been important to people was the travel policy. And anyway, we continue on that path to try to get the policies worked on. As you heard from Councilmember Davis, this is something that the City Council is interested in us cleaning up, and we agree, and but we keep working on it together.
Okay. Council Chin, is there any further update
Sure,
from you on this issue?
Yes, so there is a discussion and action item, which is on 7.3C. And so what was presented to the Joint Governance Committee is a work plan to see if they wanted to take certain policies in certain priority. The Joint Governance Committee had indicated that they would just like to take the review of the remaining policies that have not currently been adopted, city policies that have not been currently adopted by the boards, in the order that shows up in that matrix that we had previously provided to the board of which policies that we were going to accept, which ones we were going to look further into. That's the status of the work plan, though we do have premium or put priority on the two issues of contracting and procurement. That has jumped ahead in the work plan, but other than that, the work plan is subject to the board's approval.
Okay. And the next Governance Committee meeting is January.
But it does take a motion to approve that work plan.
Oh, okay.
That will be 7C.
Yes.
Okay, well, I did have just a question there. Next scheduled meeting of the Governance Committee is January 29th. Do we anticipate at that governance meeting that we would have a comprehensive recommendation on all those policies where we seek to carve out a separate policy from the city?
I don't think we will be able to go a full comprehensive review at the next governance committee. As far as, again, I'm not the chair, so I can't
Sure.
set the agenda, but based on the temperature that was provided at the last meeting, the topics that would be covered are as follows. One, the contracting and procurement policy of the board, perhaps procedures provided by Cortex on that same issue, travel policy with respect to the board only. Will be discussed at the next meeting. Investment staff was something they were considering carving out from the city policy, but for now the focus is on the board with regard to travel. And then based on the work plan, the next number or the next tranche of policies are the employment related policies. And so for the most part, I don't anticipate that we will deviate too much from the city policies, if not accept them all. The only thing what we were looking for there is compliance with Measure G with respect to the CIO and the CEO to make sure that there's no need for any carve outs there since they report to the board. I don't suspect there is, but to the extent, you know, we need to practice our diligence and look at that. So those are the general categories I would anticipate that the board, the Joint Governance Committee would cover at the January 29th meeting. And again, we invite all stakeholders to attend that meeting as well.
Okay, thank you.
I also just wanted to add one thing, is I think that one of the things that we said was that we're gonna look at, the board's gonna approve policy, but the procedures don't have to be approved by the board.
Right, but so with regard to the contracting, procurement, and policies, I do believe that it's important that the board have some visibility into what Cortex is providing to or us. I do believe the policy at a high level does require the board's input to determine which categories of services shall be, you know, critical to the plan's administration and should be falling within their constitutional fiduciary duties, as opposed to any other, you know, non-consulting goods or services that are not critical to the plan administration. So that's really the judgment call that's going to be made, I believe, at the when we discuss the policies.
Okay.
Meta, can you explain a little bit about the, I'm looking at the work plan, review for compatibility with Constitution?
Can you tell me exactly?
I think that was
which line?
training and development.
Oh, so that one we would have to look at to see, like, I haven't looked at that policy right now, but essentially what we would want to do is make sure that the frequency of any sort of training that's required for the sound administration of the plan is in regular intervals, such that our staff is up to date. And that's just a reasonableness for the plan administration.
Thank
Okay.
you.
Any further questions then? If not, we need action to accept the work plan.
I'll move we accept the work plan.
We have a motion from trustee Linder. Do we have a second?
I second.
We have a second from trustee Abbott. Is there any trustee discussion of the motion?
One more question. This is a work plan, but it doesn't have a timeline.
Right, so what our timeline generally is to, we don't have a specific end date in the timeline, so this is just a priority of when we're going to go through it. We do want to make sure we're exercising diligence. I do suspect by the January meeting that we will have, I mean, the procurement policy may have to go through a couple iterations, so I don't know exactly how many times the Joint Governance Committee may be able to meet to make that approval and then submit it back to the board. In terms of the review of the policies and how they go through, I mean, it really depends on how quickly we can get through the procurement issue and the travel policy issue, because it is a bandwidth issue for both the Joint Governance Committee's attention as well as the legal counsel and Cortex.
Yeah, I mean, my only concern is in the absence of a timeline, it just gets delayed for the...
Well, you know, I spoke to the city council and I made a commitment that we will be diligent about the review and we'll come back as quickly as possible. By the same token, I was very clear, and I think as council indicated, we didn't want it to put a timeline specifically because we want to make sure that we are diligent on the review. So we're aware of the need to be diligent and the need to come back and complete the review as quickly as possible. But I think at the end of the day, we just want to make sure that we do this only once and we do it correctly. And so, again, I don't want to speak for anybody else here, but I think that was the concept of not having a specific timeline, other than to make sure that we're diligent and come back to your boards and to the city council as early as possible.
So I just want to make sure I have a clarifying question back to Trustee Avasti. So are you asking for a timeline from when all of our evaluation of the policies in terms of whether or not we accept them or not, or whether we, sorry, let me rephrase my question. So that comment is withdrawn. So are you asking with regard to the timeline of our assessment of which policies we will follow the city policies and which ones we aren't, or are you asking when we will have all alternative policies relatedly to that initial timeline completed?
My question was for the latter.
For the latter, so for all the policies
Yeah, so that there is
completed.
less confusion in the staff about the policies that we are following. In the absence of clarity, I think the staff remains confused.
So I can tell you the process in which we're currently looking at the policies, and maybe this will give some clarification and some comfort. I think, so what we're doing is taking all the city policies that we've reserved reservation on currently. So those are the ones that are still under review. Now, we're not saying we're not going to adopt those city policies. We're just looking for compliance or, certain tweaks here and there. Our initial review of, for example, the employment-related ones, that should be a fairly quick review. We will probably get that done by January. And then the more complicated ones, like procurement, for example, may take longer. And so I do think what we will do is first look at the low-hanging policies that we more than likely will adopt, and go ahead and adopt those on a rolling basis rather than have everything come back to the board at once.
And we heard from the council member that they're counting on us coming back with a report in April. So,
I think I mentioned possibly April when I was at the meeting, but I didn't make any commitments, but I was clear that we would try to come back as quickly as possible. And by the way, the report status that was provided to the city council did include a number of policies that we already agree with, and that have been accepted and approved by the committees and the boards. And so we are just strictly speaking to the ones that council is referring to now. In terms of city council, I agree with them at the time. It looks like a large number of policies and procedures, but I tried to explain just what council indicated, that it doesn't mean that they're going to be wholesale changes to them, but tweaks here and there, except for maybe a couple of ones that we want to be very specific. But again, we're not trying to limit or to make them less stringent, but just to make sure that they have controls in place that allow us to continue fulfilling the duties of the office and to be efficient and effective for the operations of ORS. So it's a long way of telling you we're aware that there's a need. I think for us to give a timeline, I would hate to stick to a timeline that we cannot meet. So we just want to make sure that we are aware that we need to complete this as quickly as possible, and within that understanding, we have to be diligent about it. So I hope that that's enough of an explanation, but I can't really commit to a timeline.
So here's what I would say. I would say that we would be able to commit to a timeline to determine which city policies that we will more than likely adopt for the remaining tranche. That we can provide a timeline. Now, there are more complicated issues, for example, around travel, procurement, contracting, where we do need to meet and confer with the city. We do need to work together because we do use their finance department. And so I can't commit, singularly, like we will have this policy done, because we do need the city's input as well on a number of these existing more complicated policies. That's why my hesitation, I broke the question out in two. One is whether you were asking about the timeline of our review of the policies that we would, more or less adopt with slight tweaks, versus, getting all the policies in place, because that latter part is not solely the board's jurisdiction. It also involves the city as well. So that's why I had a hesitation on the second part of my question back to you.
Yeah. And I would just add, Maytek, that I think that the governance committee's plan or goal is to have things wrapped up by April. But to your point, we have other parties in here that we're going to have to negotiate with.
Right.
but I think we'll be meeting jointly.
Yes.
To hammer this out for.
Yeah,
a
and
while.
there's certain areas where I do believe there, the law, the municipal code is a little gray, and so I do think it would be incumbent on us to initiate a conversation with the city attorney's office to figure out if we can get, like, for example, an MOU or a memorandum of understanding on these gray areas and how we can work through them. And once we've gotten that done, we can also integrate that with our policies that we do bring before the board, because we can't, push something on the city if it doesn't work with their processes.
Yeah, thank you for the background.
Sure.
My request would be that we bring this item, even as a part of the governance committee, to update the board on the progress, given the fact that we don't have a timeline, so that we know, where are we? Have we reviewed everything? What is the progress on the specific policies that we are drafting? I think that would be helpful.
Yeah, I think that generally should be wrapped up within the chair of the governance committee's updates at the monthly meetings.
Yeah.
To that end, do you anticipate, so January 29th, that's after our next board meeting.
Correct.
So for the following board meeting, do you think we would have a partial recommendation on those policies we have either adopted or recommending to adopt that or different? Those that are accepted to be the same as the city, and that third category still under review?
I have to, it's with the holidays and I'm looking through my own schedule here. I believe that at the next meeting, what we can put before the committee for review, and again, the joint governance committee may have additional edits to it, so we may have to come back at another joint governance committee, but we can at least provide you the update. But the materials and topics that are going to be put before the joint governance committee is as follows: the contracting and procurement policy, as well as a travel policy for the board,
Yeah, no, I understand.
as well as the employment ones.
I'm just wondering if we would entertain a partial recommendation after part of the work is done, or we're gonna wait till the entire process is complete?
No, it will be on a rolling basis. So whatever, so for example, as you see here in the governance committee section of the agenda, anything that the governance committee has approved then shows up in our fulsome board agenda. For example, discussion action item on 7.3C. Again, this is essentially lifting what the governance committee agenda is to put before the board, because the committee can only recommend. The boards are the ones with the authority to adopt. And so that's why everything that's discussed at the governance committee will be brought before the board on a rolling basis.
Yeah, the only meeting that will not happen will be your next one, because the committee meets after, but after that, we will keep the board apprised. And that's exactly the process that I explained to the city council, which is the reason why I didn't commit to a day, because I realized between committee meetings and coming back to both boards to be approved, I couldn't really go to the city council until everything is approved. So it takes time for these public meetings to take place. But to your point, we will keep the boards apprised at every meeting, except for the next one, because the governance committee don't meet until after the meeting. But after that, we will always have a discussion item for the boards to consider.
Right, and I believe the reason why we had to wait so long for the January meeting, just by context, is we had a lack of quorum.
Yeah.
Okay. Thank you.
Any further discussions on the motion, which is still on the floor? Any public comment on the motion? So hearing none, we'll vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Linder?
Aye.
Trustee Avasti?
Aye.
Trustee Faulkner?
Aye.
And I vote aye as well. So the work plan is adopted. Now we are on to item 7.3D.
So that was generally wrapped up in my previous comments,
Is
so
that right?
that applies here.
Okay, so it was merely a discussion of the travel policy. Okay, then we're moving on to 7.4 Disability Committee. Is there an all update from the chair?
Yes, we've been busily meeting. You've been seeing some of the action on the agenda, particularly today. We anticipate potentially 3 cases that we'll be working on in our January meeting.
Okay.
But we're trying to work closely with the staff to get applications in front of us, people communicated with, and those kinds of things. So that's, hopefully this will help the board as a whole.
Absolutely, we're working through the backlog. All right, so we'll receive and file the minutes. 7.5C, Joint Personnel Committee. I note on the agenda that Trustee Jennings has been replaced by Trustee Linder, and that needs to be reflected in the agenda listing.
Right.
Our co-chair, Mr. Chandra, is not here for an oral update, but we will meet tomorrow, and we will be considering the very important work of hiring an executive search firm.
That's correct, and I can give a brief update if I may.
Please.
So at the last JPC committee, the committee meeting, the JPC had appointed an ad hoc committee to help the JPC and the boards do their executive search RFP to select a firm. We did have 3 bids submitted. We will be discussing those bids tomorrow. So that's the scope of the meeting for tomorrow. And then, I'm sorry, one more issue for tomorrow is also we are coming back to the JPC with recommendations on how to deal with issues where there's disagreements between the boards on issues of hiring, termination, discipline, compensation, and performance evaluations, and miscellaneous other, for example, waiver confidentiality issues. So those are all going to be brought to the board tomorrow, or the joint personnel committee tomorrow to consider for adoption. And once that's been adopted by the JPC, that would then come before your board for consideration and adoption.
Great, thank you. So there are no minutes to accept. Item 8, agenda and training. You will have the various training opportunities. I guess the General Assembly for Calipers is coming up down in Rancho Mirage. Always a popular event.
I will note that that's my birthday, so if anyone's there.
Well, okay. Will you be there?
I will be there.
Okay, so you're celebrating your birthday, hanging out with pension trustees.
Well, you know, oftentimes I'm called to be a speaker there, so I have to go.
That could be a motivating factor.
Absolutely, absolutely. We'll love to see you there. Any proposed agenda items? Hearing none, this meeting is adjourned.